Another key partner that was instrumental in putting this event together is somebody I want to call up right now. He's here in the room. Ryan McRobert from Fenwick. Come on up. That was super important for us to be able to put this together. Give him a round.
Thank you, everybody. This is terrifying now that I'm standing up here. Good start. Thank you. So I'm a partner at Fenwick & West, and we're a law firm, and I represent a lot of early stage, mid stage companies in Seattle and in the Bay Area as well, and some other investment firms. And it's really exciting for me to be here because first of all, this is my first time moderating a panel, so fingers crossed, hope it goes decently. Don't be too critical. I'm gonna do my best, but it's exciting to me to see a lot of different people and a lot of different partners that I know, and kind of all in one place. Pablo and I met a little over a year ago in Green Lake, and we had beers and we got together, and it's been awesome since. I see SVB and Karen, I see you, and I've worked with WTIA and also with Voyager. Hi, Bill. And with Madrona, and we're right here, and some other founders that I know from different places. So this is really exciting for me to be here and just kind of connect with everyone and kind of connect the dots, if you will. So I'm really excited to moderate this next panel, and I'm not sure where I'm supposed to sit, but thank you. If the panel members can please come up and join me up here.
Hi, I'm T.A. McCann. I'm a managing director at Pioneer Square Labs. PSL is a startup studio or incubator, and we also have a $100 million venture fund where we invest in the companies we create, but also early stage capital here in the Pacific Northwest. Prior to PSL, I'm a 5-time founder with 3 successful exits.
I'm Bill McAleer, founding partner with Voyager. We've got 5 funds, and we're investing here in the Pacific Northwest. We kind of have a 3x3 strategy, so we look at 3 geographies, which includes Oregon, Washington, and Western Canada, Alberta, and BC. And then we focus on 3 sectors, all B2B, all first venture rounds, so that's kind of where we put our time in. And we like to look at what we call enterprise transformation. We like to look at AI, analytics. We've done multiple deals in marketing analytics, as an example. And then the third area we talk about is disruptive technologies for essentially for industry disruption. And then the third thing we focus on is once we get on a board, we spend a lot of time on go-to-market. We find that a lot of companies still in the Seattle area need help on that. We also spend time on leadership development, helping recruit teams. And then the third is we help get corporate introductions, which is really important to scaling the companies. So that's kind of our playbook. And I started out originally, I was an exec at a company called Aldus here that invented desktop publishing. We merged with Adobe in the mid-90s, and then I worked with startups for about 3 years with an eye to starting a venture firm, and made investments and helped them raise capital and helped them get their strategies right. And we had a great time doing that, and I love learning. So that's the thing that gets me up every morning, is meeting an entrepreneur and learning about what they're doing and getting excited. And like Kirby, sometimes I have no idea what they're doing, but they all sound exciting. And then Emer and I are partners in crime on a bunch of different things.
Yeah, and TA and I are too. I'm Emer Dooley. I run a thing called Creative Destruction Lab, and probably the thing that unites us all here on the panel is I've asked everybody probably there and in this room for a favor at some stage, because I work at the UW, and what Creative Destruction Lab is, it's a mentoring program for deep tech startups. And the cool thing that sets us apart is we're philanthropically funded, being at the UW. So we don't take any equity in any of the companies, we don't charge any of the fees, and we specialize in 2 areas. So one is computational health, which is computing to change the future of health or medicine. The other one is advanced manufacturing, so systems, software, and processes that are going to change the way manufacturing happens around the world. It's the last bastion of digitization, and having worked in healthcare, believe me, that's saying something. The other thing is, I'm originally an electrical engineer. I had my lobotomy. I came in MBA, went and worked for a high-tech startup. And when that went public, I was like, stop the world, I want to get off. But Kirby, I'm one up on you, because I actually raised the first Alliance of Angels seed fund in 2008. So talking about terrible dips. And I remember at the time, because I'd never raised money in my life before, and I was thinking, this is a no-brainer. Like, heads I win, tails I don't lose. Nobody expects me to raise this because I've never done it before. And if I fail, it's 2008. Who cares, right? Thrilled to be here. Thank you so much for asking me, Pablo.
I've only been part of this ecosystem since 2012, so I'm excited to hear what everybody has to share. And TA, who apparently name tag wasn't available to you, but that's really what was. Everybody knows. What was the venture ecosystem like in the 90s when you were starting your first startup? What was it like that?
Was it electricity?
Well, the funny thing, I mean, you have to, I moved here in 95, and I moved here just from a pure lifestyle perspective. So I was living in San Diego. My wife and I were looking for a different place to live, a bigger city. We're from the Chicago area. Looked up and down the West Coast, and Seattle felt like the right feel of size, big enough city, and geography. I had a different job at the time, and the internet was just starting to happen. So I was sort of always the technical guy in the group, and so people were asking like, hey, could you build a website for this team that I was working on? And so, basically, the internet was happening about the same time when Kirby was starting. I started a side project, which became a company, which then I angel funded with friends and family. So I don't think I knew enough about Seattle, and I didn't certainly know enough about venture capital to answer that question. And I was also very inexperienced in my own career. So as a first-time CEO, I didn't know how to run a company, didn't know how to raise capital, I didn't know what capital was. So in some ways, I think it's weird that you have to, there's this timeline of the ecosystem, and there's this timeline of whoever's participating in the ecosystem and their own experience, of which I had very little. And that said, I brought most of the capital that I raised with me. Then I started my second company in 98. I angel funded that as well. And then I went to raise venture capital in February of 2000. Bad timing. Bad timing, couldn't raise. I remember walking out of Madrona, getting a no. I remember walking back to my office right north of the market, telling my team, like, it ain't gonna happen. Like, we're not gonna raise any money, send 12 people home, shut that company down, go get a job at Microsoft. So while I've had some success past that, that was definitely a feel of, I had just started to get exposure to what the venture ecosystem felt like in that late, like 98, 99 kind of time frame. But just a little bit too late in raising my own capital for that particular venture. But I'm a slow learner, but I'm very persistent.
So, Bill, next question for you, Laura, following on your comment. Back in the 90s when the internet was invented and the light bulb was just showing up in our lives, what was it like for you raising your first fund in the 90s when I was not part of the ecosystem?
Well, that was my startup. So we started Voyager back in '97. So we've been doing this for about 25 years. And at the time, we had been working with early stage companies, and had realized that there was going to be a lot of opportunity here. And not only internet was happening, but the other thing that was happening was multimedia. It was huge here. And the other thing that was happening was Macaw and mobile. And so when you think about this ecosystem, it was setting up perfectly for the internet because it was a combination of what you could see, a combination of mobile, rich media, and internet. And so our observation was that there were not very many firms here. And the firms at the time, and this is about the time when Madrona, us, and Ignition all started, were all people that had no idea what was going on in technology. And I actually went and interviewed with one of them. And they said, well, we don't have any openings, but maybe you could only start your own. So I said, okay, fine, we'll start our own. So 3 of us started it, and when we started it, it was we took a pretty intentional strategy. So we actually started by aggregating a bunch of the really well-known angels at the time, people like Scott Oakey, Paul Brainerd, who started Aldous, et cetera. They were early investors. That gave us credibility. Then we went to institutional investors. We got Merrill Lynch, we got Citibank. And we raised at that time a $50 million fund, which in today's dollars is probably, 100 million, maybe something like that. And that got us started, and then we started making investments here. And fortunately, we had a couple of deals that actually I had been working on that we were able to fund. And one was actually the first video. It was sort of the predecessor to Zoom, a company called NetPodium, which we made 10 times our money on in about 2 years. And what they were doing, and it was really at the time, you had, internet connection was dial-up. If you had any kind of dial tone, you were like really lucky. And these guys were trying to do broadcast basically over the internet. And it was started by an ex-Adobe guy that we knew. And it turned out that that was a pretty cool deal. We did another deal called TGIC, which also got us on the map. And these guys were taking your text messaging on your phone, or your numeric entry on your phone, and turning it into text messaging. And we had a huge debate internally at the firm because you had to vote initially. 3 partners had to vote on a deal. And one of my partners said, well, I think speech is going to trump text messaging. And I'm like, have you ever been to Europe? Have you ever seen what's going on in Europe with text messaging? And so I finally convinced him to do it, and we did that deal, which was also a really good success, an early one. But our biggest early success was a company called Aquantive, and these guys were really the pioneers in internet advertising. And so this was right in the middle of the internet boom. And the company went public. We had a huge public offering. It was the largest in Seattle history at the time. And then 2001 hit. And I remember a board meeting where we're sitting around the board with the California investors. And one of the investors said, we ought to just shut the company down and distribute the proceeds because our customers are all internet companies. But they forgot there was one customer, which was Microsoft. And at that point, the stock was trading for $2 a share. And it had gone out on the public offering and traded up to like 120 or something. And the one guy goes, yeah, I think I'm going to liquidate my position. We said, we're going to hang in there and see how this does. And eventually it sold for $6 billion to Microsoft. But that one customer made the difference in that company. So it was hard to raise a fund at that time. There was not very many angels in the market, but the angels that were here were pretty prolific, and you knew who they were. They were actually supporting companies, and it was great. There was no incubators at the time. There were no early stage funds. And basically there were 3 of us that started the venture capital community here. And then as we got into 2000, which we'll get into, we started to see accelerators coming and other funds. But that's kind of how we got going.
Legendary. Thanks, Bill. That was awesome. Next question for Emer. Emer, sorry. Something that's near and dear to my heart as UW grad. I would love to hear kind of the history of what UW has the University of Washington, for those of you who aren't local.
Oh, come on. Is there anybody here who doesn't know what the UW is? You can leave now.
There's even a purple shirt.
I would love to hear the history of kind of the programs that the University of Washington has had for startups, going back to the 90s, what that looked like then, how it's changed, to what we have now, with a lot of different various programs between commotion and perspective, and a lot of colleges within the university have programs.
First of all, I have to say it's a hard act to follow, Bill. Because Guy Kawasaki, who was one of the early evangelists at Apple, right, the guy who took them international, once said to us at a group meeting in Seattle, he says, "Thank God for Paul Brainerd, who started Adobe, because otherwise, desktop publishing would never have happened." So you got to understand that stuff started in Seattle,
Apple
right?
wouldn't have happened either.
Apple would never have been the company it was, right? So you got to appreciate, being, as you said, the more tenured people here. That was so. Thank you. That was very diplomatic. I'm just glad Ed Lasowski is here because because he would have been the oldest. We won't say who is now. But no, the UW. If you look at the UW, it's just an incredible economic engine. So from a startup perspective, over the last, since the UW really started counting, they've spun out, companies that have raised about $10 billion. In the last 5 years alone, they've spun out companies, just to show you the acceleration, companies that have raised $5 billion. But none of that existed, really. I mean, yes, very early on, some fundamental ultrasound came out of the UW, portable kidney dialysis came out of the UW. So it's always been this engine for innovation, but the university sort of didn't know the assets it was sitting on. And way before there was a tech licensing organization at the University of Washington, a bunch of the people that I'm sure Laura, will talk about very, very well, Hunter Simpson, who started Physiocontrol, and people like Bill Gates Sr. and Tom Cable, the first, real venture capital fund in Seattle. They got together and they said, the University of Washington is sitting on this gold mine of innovation and we're doing nothing with it. So they started this organization, and this predates CoMotion, called the Washington Research Foundation. And they licensed the technologies to make sure that the money went back to research institutions within the state. So one of the very first ones that they licensed was this patent on a thing to basically create yeast that had become the future of growing all biotech drugs from then on. Started by, just this amazing UW entrepreneur. It brought over $1 billion to the university. And that was, and now the the Washington Research Foundation has a corpus of about $300 million that it uses all the time to invest in early stage technology coming out of research institutions. So CoMotion then, the university woke up and said, okay, we need to do this for ourselves. And now they do, 500 patents a year. Thousands of companies have come out of the University of Washington. But if you look at just some of the huge successes, because this is a hit-driven business, right, the whole thing. Yeah. In the last 10, 11 years, there's one group at the University of Washington called the Institute of Protein Design. Brilliant founder called David Baker, who basically, invented the field of computational biology and created an open source software thing called Rosetta. But that group alone has spun out 11 companies over the last, 11 years that really, and none of that existed before. And these are things like people who don't even know what a protein is. If you think about it, so many people suffer from celiac disease. The first company that came out of the Institute of Protein Design has basically invented an enzyme that'll digest gluten if you've got celiac disease. So it'll be like a lactate tablet. Got all the way through phase 2 trials. Fabulous entrepreneur, Ingrid Swanson-Pulse. She's an amazing person. She's a CDL mentor. But she sold that company to Takeda for $330 million when they saw how successful the phase 2 trials are. So that's what the UW is doing, but it took a while to get there, and WRF predated all that.
It's fantastic.
One other thing to add, a lot of people may not know this, but UW is either the number 1 or number 2 highest federally funded institution in the country. So part of what, number 1 maybe now. But what you need in an ecosystem like this is you need heavy research. And we've got corporate research, we've got UW research, and if you actually go beyond Seattle, you see it in other cities like Vancouver, and you see it up in Calgary and also in Portland. And so that's an element. Plus, to your point, you need some big whales to spin people off.
I mean, I think all of us are involved one way or another, or multiple ways with UW, and it's hard to understate not only what I would call the permeability of the city and the university, the back and forth, whether it be people doing industry going that direction, or people coming out of the university to do other things, or as you just mentioned, the quality of the students and the education in some very important areas like computer science or protein design, and the pure entrepreneurial programs, of which we're all very involved with there, and those are at the undergraduate level, the graduate level, the transfer level. So it's very difficult when, we're all in this ecosystem, but when you go drop into another place that doesn't have a UW, it's hard to think about building the ecosystem the same way. So it's just one that we should all really appreciate, and if you have the opportunity to spend time there in any way, shape, or form,
Talk to me if you don't.
It's amazing, and all of us are deeply involved in one way, shape, or form. And I just want to make one other point about that, which is Microsoft. We'll mention a lot of Microsoft along the way, and Microsoft has been such an important part of this ecosystem forever, and that can be everything from taking failed founders and giving them a job for a couple of years to recharge their bank account, or building the infrastructure that they have, or spinning people back out, or bringing people to Seattle, and all the amazing stuff that's happening right now with Microsoft. I mean, it's just hard to not say kind of like a thank you to Microsoft as part of this community. I mean, hundreds of thousands of
and Amazon.
Absolutely.
Yeah. But just to this is one of the things with a moderator, this control of the panel. But just to pile on the Microsoft thing, Well, when we started Voyager, we thought we would get money from Microsoft entrepreneurs, number one. Number two, we actually thought we'd see some Microsoft entrepreneurs. This is back in '87, right? Both failed. The Microsoft executives, when we asked them to put money into our fund, I'd rather put it in T-bills because I already have a tech investment. Second thing was, then Microsoft entrepreneurs, generally, with a few exceptions like Real Networks and others, didn't understand go-to-market. So when they came in and they pitched us, they want to build a platform, number one, which is like a snoozer as soon as we hear that. The second thing is, because that's almost impossible, there's probably only 2 or 3 companies in the world that build a platform. The second thing is, then they would say, well, you know, I know because I have a great product, this product's going to sell like crazy. And then you'd ask them, like, how are you going to sell it? Don't really know the answer to that. And that was because all they had to do was put their business card down, plug it into their distribution channel, and it would sell, right? Now that's changed, and I think with Sadia's leadership, it's a completely different company. And the other question,
Never bought a quantum.
right, yeah. And the last question they would ask, you know, that would happen, that was also kind of funny is, you know, you'd ask people like, what does it look like for an exit? Well, we always want to go public, you know, and that was sort of that was what they were used to, right? They were a public company, but it takes a whole lot of work to build a company. But I think a lot of that's changed. Microsoft used to be very closed loop. If you talk to somebody who worked there, even friends back in the 90s, they would never tell you anything about what was going on. You'd like, oh, what department are you working in? I can't tell you. But that's also changed. And so I think Sadia has done an amazing job, and it's generating a lot of deal flow now.
Sorry. No, it's great.
Did you have any questions?
I'm gonna combine the next 2 questions and then skip over about 6 of them. So just keep things moving. All right, so Billy, you talked about, everyone here has talked about the 90s, I think, and I think we can kind of shift timelines to, you know, after the 90s, after the dot-com bust that we're all aware of, you know, when the dust cleared, when the grass started growing again. You know, what was the funding landscape like after that? Who were the accelerators and incubators who came into the picture? You know, what happened? How long did it take? And so on and so forth.
Well, you know, it took, as Kirby said, it took about 2 to 3 years to settle out. So it was a pretty big hit. And even us, like the other issue you see, and we're seeing it now, although I think we're past it, is after these crashes or these dips, it takes probably 6 to 9 months for the early stage valuations to level off to where they should be. You know, and in this most recent run up, and I think Kirby may have alluded this a little bit, you know, we saw companies that coming in with no revenues and saying, hey, I want a $30 million pre-money. And they were getting it from some not so smart investors. Because the issue is that you're gonna have to look to the next round, right? And get that valuation. And if you don't have any revenue, it's really hard to do that. So we have seen in that period, there was probably a 6 to 9 month lag. So people were not investing because everybody was waiting to see what was going to happen. And then you had the whole public market and the exit market shut down. So that was like a double hit. And then, but what was happening was actually there were some pretty good opportunities that came around. And I think we're going to see it again, because we're shifting in terms of a sort of a sea shift. One of the things that was happening is we were starting to see the little inklings of client server moving to cloud. Now, it was very early at that point, but you were starting to see that another trend was potentially developing. And when you're investing in venture, the ideal place to be on these trends is a little bit behind what's called the Gartner hype curve. You either invest on the front end of that and sell on the top of that curve, or you invest on the back end of that curve and wait a little while till it comes out. And you know, I think we saw some pretty good opportunities get funded in the 03, 04 period, including we had a couple companies that did really well during that period. So I think the parallel is somewhat similar now. I don't think it's going to be as long as a cycle as we saw, but a lot of it depends on what happens with interest rates. On the incubator side, We saw incubators spring up like crazy in 2000, 2001. It was like a fad. There were hundreds of them, and they all failed. And the reason they failed was largely they weren't adding value like we're seeing like a PSL do today.
Let's skip ahead. Okay, so look, from a legal perspective, I like this question a lot. Like, how have deal terms evolved?
Oh, can I just talk? Because this is the one thing that came into my head. You guys can talk about how deal terms involved, but when, yeah, it's like the politician, answer the question you want to answer. No, but one of the funniest things was when you started talking about us being ancient and being around, like at the beginning. I remember at the very beginning, like there were not two lawyers in the city that could sit opposite a table from each other and negotiate term sheets.
Yeah.
Like this was back when Craig Sherman worked with Venture Law,
Yeah.
and we thought it was super cool that they had moved from the Bay Area to
the
set up the first venture law firm in Seattle. So it's just incredible because I was saying to somebody else this morning, I'm on an advisory board for the Irish Development Authority around technology, and they're asking me, why are all these companies exiting before they hit, go public and hit billion-dollar valuations? And the reason is it's a generational thing. If you don't have people in your community who have created, built, and exited billion-dollar companies, you don't have people who know how to build, create, and exit billion-dollar companies. And we're finally on our second and third generation here in Seattle. And we're not there yet in Ireland. And if you start to see, the other thing that's really cool about here is you're seeing people who've built incredible enterprise software companies, because that's what Seattle was so great at, like Sujo Patel with Isilon, or Raj Singh with Concur. Now go to the next generation and start building computational bio companies like Nautilus, or health companies like our data systems companies like Accolade. And that's what's great about being part of a dynamic community like this, that it's continually evolving, and we're bringing, like Seattle is one of the leading companies on bringing computing and biotech together. And it's just such a privilege to be in this community and to see that happen, and to be part of help making that happen. So now, what did you want to ask?
Oh, sorry. So I wanted to ask about deal terms. Like, as an example, since in the last 10 years, I've seen, for example, like the promissory note go from being the preeminent method of raising prior to an equity round to being very rare and the safe becoming the preeminent method for raising. I've seen, NVCA forms become, very standard across the board. Just an example, but how have you seen deal terms shift since the 90s? How have you seen the pace and the structure of deals change?
Should take that one.
Okay, well, I'll give a shot at it and you guys pitch in.
We all want to talk about safes.
Yeah.
So exciting.
We don't like, just this is we don't like safes, so that's not one of our favorite investment vehicles. We actually like price rounds. We like to go in and price around and get aligned with the entrepreneur and build a company. However, safes are great for the angel community and the smaller funds. And the smaller funds are the feeders to the funds that are doing what we call seed investing now, which used to be old Series A. So one thing that's happened is I call it the letter downshift. So it used to be a Series A was like a $2 to $4 million, round, and you price it at 8, 10 million or something like that, and that changed. So thanks to Silicon Valley, that's now called a seed round, maybe a pre-seed round. So that's one change. So when you look at a Series A now, it's a much larger round. You have much higher bar in terms of what people are looking for, like on SaaS companies. It's usually, for a Series A today, it's probably like a couple million, $3 million, $4 million in ARR. And for a seed deal now, oftentimes it's $1 million in ARR, and the pre-seed typically, people are investing prior, to revenue. Now we'll invest in those two phases, pre and seed. I think the other thing that happened way back when, there used to be what were called ratchets on late stage rounds, which we never did because it didn't align the entrepreneur with the investment firm. But what would happen is somebody would want a really large valuation. They had revenues typically, and they said, okay, if you hit your target for the year, great, your price sticks. If you didn't hit your target for the year, we have what's called a ratchet, which would bring your valuation down based on a multiple. Those are gone, thank God, because I don't think they were very good. But we saw those in late stage deals. The other thing that happened during the downturn is you would see a lot of recaps, and I would predict we're going to see that again because there's been a lot of companies funded at massively crazy valuations during this run-up, and they're going to come back and want capital. And unfortunately, whoever the last investor was that paid that are going to see some impact on their overall valuation. We just looked at a deal in Calgary, priced at $30 million pre, raised $10 million on basically two founders that had a company in the space before. It's been repriced to $10 million on a $2 million round. So that's an example of a company that now has some revenue, but is going through a big change.
What I think, to draw on Kirby's point previously, if you think about the sort of dot-com crash, so many companies got public and then they failed. And in this case, there's a lot of companies that were close but never got public. And those companies are the ones that, there's a lot of recapping that's going to happen at every stage. D, C, B, A, all of those are likely to happen in this next 12 to 18 months. So I think that's the part that's going to be similar in the sense that a lot of companies are either going to totally run out of money, can't raise, will fail, but you won't see it as publicly because they weren't public. They never got that far. And a lot of the people who were close, like we have a couple of these in this race, like, we were so close, only like 3 or 4 months away from going public, and now it's going to back up a lot.
The other thing that happened in the 2000 era was a lot of companies went public without a business model, and they could get the public money. Yeah, right. But that one actually found a business model, so that was good. But we didn't see that so much this go around. But to your point, TA, we did see it on later stage companies where they're getting like crazy valuations for, relatively small revenue streams.
If you take it back, if you think about it in that sort of mid-late 90s or even early 2000s, the number of seed funds or angel investors writing checks was a fraction of what it was over the last 12 to 24 months. So there's so many hundreds and hundreds of 20, 50, $100 million funds that so many companies got funded at that $2 million, $5 million, $10 million level. That is a gigantic bubble of companies that is likely to struggle or go out of business in the next 12 to 18 months as they can't raise.
I'm told we're out of time, so.
Well, we should make one last point. We got to leave on an optimistic point here. Sorry, and I'll make it quick. We think this is a great time to invest. Number one, we've got people coming out of bigger companies that unfortunately have been laid off, but they're looking to do something new and exciting. That happened before, and it was great. And this ecosystem is so much richer. The second is we're going to see companies are going to get repriced, which is great for investors, but the companies will get repriced. And the third is we're going through a massive shift here with generative AI, and it's being hyped, but this is a serious trend in computing that is going to probably be as big as cloud and maybe bigger. So let's leave on that note.
Can I just pile on that? I feel like
You're on a good roll.
the thing that,
So how did your first time moderating go?
to draw the parallel to 95 to now is I think that basically the web browser put a consumer front end on the internet. It allowed normal people to see what the internet was, whereas only technical people prior to that, really, right? And I feel like primarily ChatGPT has done the same thing. So for all of us who've been in this space for a long time, building technology, to Kirby's point, we've been building basically AI and ML solutions for a long period of time. 10, 20, I was working on this in the early 2000s, a long time, but there wasn't a consumer front end on it. And that, I think, is one of the biggest innovations over the last 6 to 12 months is primarily ChatGPT, but others where you just go there like, oh, now I get it, which feels quite similar to that point in time in 1995.
And just to move beyond ChatGPT, if you think about ChatGPT, it's based on text, right? Which is a pretty poor representation of the real world. Think of when generative AI really starts to take over how we manufacture, how we do things in this country and across the world. And so to leave it on a positive note, because It sounds like we were not put in charge of morale tonight. There's just such an incredible future for companies based on generative AI, and it's happening so quickly. If anybody listens to the Lex Friedman podcast, there's a phenomenal interview with Mark Andreessen this week that's really worth listening to about this.
Thank you all very much. This was really enjoyable. Everyone was very kind. Thank you. Really appreciate the panelists. Thank you so much.